In this video, we'll discuss the pros and cons of reverse mortgages. Now, just who should consider a reverse mortgage? Well, if you live in a good real estate market, since you're taking out a loan on your home, you want to be sure that you can pay back the loan with the equity if you decide to move or sell your house. In a declining market, you may find yourself upside down on the mortgage and be unable to satisfy the loan upon sale. If you need extra money or income, if you are in need of extra money to pay medical bills, taxes, or maintenance for your home, a reverse mortgage can be a good way to obtain those funds. It can also be a good way to supplement your retirement income with ongoing monthly payments. Also, if you're older with an abundance of equity. The older you are and the more equity that you have in your home, the more favorable terms you'll receive for your loan. Your chance of approval will be higher, and you can receive a substantially lower interest rate under these ideal conditions for the lender. And finally, if you have a contingency plan, it's important that you have a plan and a budget in place to sell your home should you decide to move to another location, such as a child's home or to a retirement home. Now, what are the disadvantages of a reverse mortgage? Well, first, there are higher fees and interest rates. The interest rate on a reverse mortgage is generally higher than for traditional home mortgages, especially if you don't have an abundance of equity. Lenders also tend to charge loan-related fees, such as origination fees, that are typically somewhat higher than for other mortgages. Also, your heirs may not inherit your home. Since the loan must be paid off upon your death, any heirs that were living in the home or hope to own the home will have to either pay off the balance with proceeds from the estate or out of their own funds. Also, you must repay the loan if you move out. If you decide to move out of your residence or are in a situation where you cannot live there for a year or more, you would have to start repaying the loan. This type of situation could be triggered if you were confined to a long-term care facility, for example, forcing you to either sell the home or start making payments. And home expenses are still your responsibility. Property taxes, homeowners insurance, and maintenance costs are still your responsibility with reverse mortgages. With enough equity, you may be able to cover those expenses with your monthly payment. If not, the loan may not be a solution to your financial problems. Now, before making a final decision about applying for a reverse mortgage, be sure to do your due diligence and weigh the pros and cons very carefully. This unique type of loan can be a good financial tool under the right circumstances. If it's important to you to leave your family home to your heirs, or if you want to have the flexibility to move to a warmer climate in the future, then this may not be the best vehicle for your financial needs. But if you're settled in and you want to tap into the abundance of equity you have in your home, be sure to explore all of your loan options so that you can enjoy the best terms and the maximum benefit that your largest asset can provide.